This video is going to give you my top 6 funds on Charles Schwab, and it's going to be a mix of growth, value, higher risk, lower risk, cash flowing, and everything in between. So whichever one calls out to your heart, you're going to be able to go ahead and take the research that I've started for you and continue that research and pick the best 1 or 2 or 3 for you. I'm Professor G, and the goal of this channel is to make investing simplified, and in my opinion, there's nothing simpler than an ETF or an index fund investing. Now these funds are listed in no particular order, they're just 6 of the top ones that I like from Charles Schwab. First on the list is a value ETF, and this is so important, especially as we're seeing right now in this market downturn. We're seeing a bunch of stocks and a bunch of ETFs that are just crashing and burning, and it's because they had too much growth stock and seemingly not enough value. It's times like these where we're reminded that value investing is still relevant, and it's what got all the greats super rich, like Warren Buffett, Benjamin Graham, Ray Dalio. Anyone that you look up to, probably a value investor that got them started, and then they threw some gasoline on the fire when they started making their millions. But anyway, the first ETF on my list is called Schwab US Large Cap Value ETF, SCHV. It is an ETF that tracks the Dow Jones US Large Cap Value Total Stock Market Index, resulting in a portfolio of roughly 500 holdings with an average market value of $84 billion. These are large companies that are very safe and stable, but still not overvalued, so you're getting pieces of them at a deal. At the moment, financials are the top sector, followed by healthcare, and then industrials. Top holdings include the likes of Berkshire Hathaway and JP Morgan. And not only is it beating the S&P 500 year to date, but it also has a larger dividend as well. So this one is safe, strong, and pays a dividend of over 2.3%. Now, whenever I look at ETFs, I definitely look at the expense ratio, and that's what you should look at too. Anything over 0.15 is a little too expensive for me, and these ones are all super cheap. This one has an expense ratio of 0.04%. Year to date, the fund is down 11%. Over the last 10 years, it's had an average annual return of 11% per year, which is amazing, and it's got a PE ratio of 14. When I look at PE ratios, I just want to make sure that it's under 20. If it's a growth stock or growth fund, then I want it under 30. So 14 on this one is awesome. Now the next Schwab ETF on my list is a growth ETF, and it's actually becoming one of my favorite growth ETFs out of everything out there. And the crazy thing is, I only found out about this one because I had somebody in the private Patreon group that was asking about it and gave me a bunch of facts on it, and I looked deeper into it. So if you're interested in being in a group of like-minded investors and you want to take this seriously in 2023, it only costs $20 to be in this private group. We meet every 2 weeks on a live Zoom, so you can ask me anything and talk with each other. And we have a live group chat where I post a lot of my thoughts and what I'm buying and what I'm thinking about during all this crazy economic stuff going on. The link's down below, but let's get back to it. So this growth ETF that I'm absolutely loving is called SCHG. The Schwab US Large Cap Growth ETF includes 247 stocks from companies that are expected to experience above average growth. Its biggest sector is information technology and then healthcare, and 3 of its largest holdings include tech behemoths, Apple, Microsoft, and Amazon. Now growth funds are so much fun because of the upside. These bad boys can just shoot off, and they're the ones that can bring you the most appreciation seemingly out of nowhere. This fund over the last 10 years has grown an average of 14% every single year. If you were to put just $100 per week into a fund that returned 14% per year, in 30 years, you would have over $1.7 million from just $100 a week. Now, when I say average returns, that doesn't mean that you'll always make exactly 14% every year. Some years will be 30% and some years will be negative, which is what we're seeing right now, as it's down 32% for this year. So it's one of the hardest hit by far. As far as expense ratio, it's at 0.04, which is so low compared to other famous growth funds like QQQ, which is at 0.20, and then ARK with 0.75, which is crazy expensive. This PE ratio is at 26, index, which again is actually pretty good, especially since for my growth stuff, I like to see under 30. Now this next option is even riskier, and it's one that covers the emerging markets. I included this one because if we're gonna go with something international, I think your best bet is to go with the emerging markets because of its upside. This gives you the best chance to be able to get into some of these companies that are still kind of figuring it out before they've hit their real growth trajectory. This one has a ticker symbol of SCHE, which tracks the FTSE Emerging Index, and it owns a wide basket of over 1,800 stocks from countries including China, Taiwan, and India. The index is market cap weighted, so mega caps such as Taiwan Semiconductor and Tencent have the most impact on the fund's performance. Now this one has the highest expense ratio out of all the ETFs that I'm going to show you today, but it's still pretty low at only 0.11. Year to date, it's down 20%. Over the last 10 years, it's grown an average of 2.5% per year, and it has a dividend of about 3%. Its PE ratio is very low at 10, and so those were not very exciting numbers, but remember, we're not investing for today or today's value of this fund, we're investing in what it could be, hence emerging. This is the perfect fund to add to your portfolio, especially if you already have a bunch of safe fundamental picks like the S&P 500 or the total stock market or anything like that. This will just add a little bit of risk, but with high risk comes high reward. I would definitely recommend making this a very small portion of your portfolio, and let's move right along. Now this next one is actually considered a mutual fund, but it doesn't have the negative connotations that I normally give to mutual funds, which usually has to do with the fact that they have crazy fees or weird fees. This one actually checks out. And if you invest in the Charles Schwab platform, this is the best deal I've seen on expense ratio, coming in at 0.02%. This fund tracks the S&P 500, and if you've been following this channel for any period of time, you know that the S&P 500 is one of my top 2 investments easily. This one is called SWPPX. Real quick info on the S&P 500. It's an index fund that holds the top 500 companies that we have in the United States by market cap, and it's very diversified, very strong, and has stood the test of time as one of the longest standing index funds that's actually crushed it. You could literally invest in just this one ETF or mutual fund that tracks the S&P 500 as your only investment ever, and you would be totally fine. Now this one specifically, SWPPX, year to date is down about 20%. Over the last 10 years, it's had an average appreciation of over 13% per year, which is awesome. The PE ratio is a little over 18, which is very low, which is what I like to see. All in all, I can't say enough about this one, but let's move to the next one. The next one is just like the S&P 500 in that it's a fundamental fund that literally everybody should just have in their portfolio, and especially if you're a beginner or have only been investing for 3 years or less, you for sure need to look into either this fund that I'm about to talk about or the one I just talked about. Both of them return almost exactly the same, and so just pick one or the other. You don't need both because there's a lot of overlap there. Some may say this one though is a little bit safer in that it's even more broad of an index, and it holds over 2,500 companies within this one ETF. This one is more commonly referred to as the total stock market index, which means it doesn't just have the biggest companies, it has a mix of all different types. This one's the Schwab US Broad Market ETF, SCHB. It tracks the Dow Jones US Broad Stock Market Total Return Index. Schwab US Broad Market ETF consists of North American companies such as Apple, Johnson & Johnson, Visa, and JP Morgan Chase. This one has an expense ratio of 0.03%. It's down about 21.6%. Over the last 10 years, it's had an average appreciation of almost 13% per year, and the PE ratio is 17. So as you can see, these numbers are very similar to the S&P 500 one that I just showed you, so you pick whichever one you like better, but make sure there's one of them in your portfolio. For me personally, I like the S&P 500 better. I don't know if it's just the business professor in me or what, but I like the idea of our 500 biggest and strongest companies over just a random mix of a whole bunch just to be diversified. But the numbers don't lie, pretty much the same same thing. Just go with the one that you like the most. All right, this last one is just blowing my mind. It is down the least out of all the funds at only negative 7.5%, which is less than even the value fund. It has about the same return as the growth fund that we talked about earlier, SCHG, with a 10-year average rate of return at 14%. It has the highest dividend yield at 3.3 to 3.5%, and its expense ratio is only 0.06%. This one is a rock star and needs to be on everyone's list. This is the Schwab US Dividend Equity ETF, SCHD. It tracks the Dow Jones US Dividend 100 Index and has holdings in 104 companies. This index includes high dividend yielding stocks from companies with solid fundamentals and a consistent dividend payouts. This one is my favorite by far and is actually becoming my favorite ETF overall, even more than the S&P 500. And if you want to go super deep and understand why this will be the fund that I'm going to be investing a bunch of money in this year, you should watch this video now and learn everything there is to learn about this amazing ETF.